Okay, everybody, good evening. Our next to last week of our class for this spring term, really the last official class. Next week we have all our variety of assignments due, and we'll wrap up the class with some discussions about the course and about going further on in your business major, in your business administration major, and we'll talk about that. And then we will have a class, even though it's Memorial Day weekend, and I apologize for that, but we ain't going anywhere anyways, unless you're I gotta watch my political leanings here. So we will have class for about an hour or so next Monday evening, just to make sure everybody is on the same page as far as turning everything in and wrapping up the course. Tonight we're going to talk about look at one more time chapter 18, chapter 19, and then talk about the break-even analysis in chapter 21. All these are included in your examination. The examination will be posted this evening to Blackboard, and it's due next Monday night to Blackboard. It covers chapters 8 through 11, 13, 18, 19, and 21. It's a combination of journal entries, calculations, true and false, multiple choice. Kind of long. You should have plan on a couple hours, 2 or 3 hours to complete it as far as your scheduling is concerned, but you have plenty of time. Your 10K paper is due also next Monday. If any of you, I know 1 or 2 people have already posted their work. If you have any questions or concerns in these last few days about that paper, please let me know. And then if everything is posted accordingly and we complete our course next Monday, all the grades will be posted next Thursday, or a week from Thursday, May 28th, to Blackboard. And that's assuming your course evaluations are done. If your course evaluation is not completed by Wednesday the 27th, no big deal, doesn't affect your grade at all. It's just to make sure that we get some feedback from you, and you'll just have to wait for the registrar to post your grades about 10 days later. There is a link to the evaluations in my Laverne, associated with the exam, that's posted tonight. If you go to the last page, you'll see some information about how to do those course evaluations and a link to those evaluations if anybody has never done those before. I think administratively, that's all we have to worry about tonight. I'm going to review a little bit of quiz number 3, which the grades have been posted. And speaking of grades, I urge you all in the next few days is to go into Blackboard, go into your grade center, and make sure you understand where you stand in this class heading into these last 2 important grades. Basically, 33%, maybe even a little bit more, is up for grabs in this last week between the paper and the examination. So that's a lot of grades. So make sure you have looked at your grade average and the grades associated with that. Some of us have missed some work during the course of the term, and that has affected some of your course grades. If you do not understand that, if you have somehow posted that work and I missed it, please let me know. But I've gone through the discussion forums and I've gone through my emails and I do not see anything. But if I missed it, I can make mistakes. Be sure to let me know. So one of the tasks you should do this next week is make sure your grades are what you think they are. And if there's some questions or some concerns, please feel free to let me know. Because once I get all the work next Monday, I'll be crunching the numbers on Tuesday and getting ready to post those grades next Thursday. So if there's any doubt or any concern on your part of your grade or any of the work posted, please let me know subsequently and make sure you and I are on the same page. One of the difficult things about online, one of the cons, I guess you could say, about online is you kind of lose track of communications with your professor. You don't see him on a regular basis live. And when you're online, sometimes we tend to do other things to multitask while we're listening to the professor online, and maybe we don't catch all the information we should get or get feedback. So again, spend some time this week looking over your grades and looking over your averages, your cumulative averages, to make sure you feel comfortable with what you've done and going forward. Anybody have any questions in that regard?
No, Professor.
Okay, very good. You don't have to answer, but that's, thank you. Thank you.
Sorry.
All right. So that's good. All right. So let's continue on. We're going to do some review tonight and open it up for any questions that anybody might have on their paper, and move forward to finishing this stuff up. Chapter 21 is our last chapter on break-even analysis. You will be prepared after doing that for the next step in your academic career, which many of you will be the business finance class, or some class very similar to that, either in the summer or the fall term, and that'll get you prepared for that class and the associated work that's going to be involved in that. If any of you are planning on taking the business finance course with me, next Friday is an important date, May 22nd. I will be uploading the Blackboard file or the Blackboard folders for that class, Business 330, and also sending out the course syllabus and schedule to you all in an email, plus an introduction video for the class. And that's going out this coming Friday, May 22nd. I know it's a little bit early. Class doesn't start, I believe, until that the week of June 8th, I believe. But I wanted to get all that information out to you all, and not to scare you or anything, but just show you have it. You have a little bit of time to look over it and get ready and prepared for the next step in completing your business degree. So look forward to that. All right, let's take a
Professor?
Yes.
Can I ask a question on that class? Are you going to be doing a WebEx, or is it going to be strictly online?
Well, WebEx is online.
Well, yeah, but not everybody will do it, like a WebEx or a Zoom or something like that. Sometimes it's
in your class, you don't have any way of communicating with your professor? I don't want to know about this. Don't tell me, because yeah, I can't believe you're paying money for a class where the professor's not talking to you at least weekly, in some shape or form. All right, I'm not going. Don't tell me, because I'll get pissed off if you tell me that.
Okay. No, I'm not. I don't want you to get pissed off. But I just wanted to double check. That's all.
Yes, the class will be not WebEx. It's going to be Zoom. This next class will be Zoom.
Okay.
The reason for that is the numbers are a little bit higher. There's more students in the class, and Zoom makes it a little bit easier for me to do what I want to do in that class. So we will be using Zoom. I believe I'm going to have a designated night for that class, and I don't have it in front of me right now. Well, wait a minute, do I? I don't. I think the designated night for that class is Tuesday night, I believe, 6 to 8:30 at night, where you can always depend I'll be there. So I'm going to treat it just like this class, like we were supposed to be meeting in Burbank. But we'll be meeting online. Now, some weeks, some people cannot attend that schedule of Tuesday nights. I will be recording every class like I've been doing here, and you can keep up to date. We'll have weekly office hours, be just like this class, but where you're going to be using Zoom instead of WebEx. Okay. Any other questions on that class? Professors are teaching a class that is not meeting at a campus site, and they're not communicating with their students. Okay. And they call me stupid. Unbelievable. You guys should put a good beef up about that one. All right, so let's move on as I get myself deeper and deeper in trouble. Let's take a look at the quiz. Again, very good job by almost everybody in the quiz. I posted the solutions to Blackboard. Sorry, I was a little bit late. But again, this is just like you guys in trying to end the term inundated by a lot of faculty demands like papers and examinations and work. I am being inundated by that as well from my students, and I'm getting a little bit behind, but fortunately I made it within my week, barely made it within my week deadline, and so here we are. So, okay, the first question, and again, everybody did this very well. As a matter of fact, I might even, I'll go through it, but everybody got this question pretty well right, was to reconcile the Lying Boat Company with a reconciling balance of being $7,700. That was the reconciliation balance between the bank and the cash per the books. The journal entries to adjust the cash account to $7,700 was here, and everybody did those correctly. The accounts receivable problem, where you had to set up a bad debt expense and put it into the allowance account, write off or reinstate some accounts receivable that had been previously written off, and record the adjustment in the allowance for doubtful accounts for specific accounts receivable. And then tell me what's the situation in the allowance, the balance account of accounts receivable before the write-off and after the write-off. There was no journal entry necessary for this, just a statement to that regard. What was the accounts receivable balance after those situations? So that's what I was looking for in Chapter 9. Again, very nice work. And in Chapter 10, the third question, everybody got right. No hassles, no problems with depreciation. Good thing about this here, we didn't have to do any journal entries. On the exam, you will have to do a journal entry in regards to this, so stay tuned for coming attractions. And the straight line method of taking the cost of the asset minus out the salvage value over the length of the asset times $17,000 a year, and based on the units of activity, excuse me, the units of activity per year and the according schedule accordingly. And as you can see, they're both expensing or writing off or expensing $85,000. But the usage is a little bit different compared to the straight line. So that's what I was looking for there, the comparison or the difference between the two. And that was it. A good job, a good practice for the exam, and nice work by all. So those grades are up, and the solutions are up as a study guide should you need them, but I don't think you guys are going to have too many problems with these questions on the examination. Any questions on quiz number 3? You guys are too easy tonight. Okay. Well, let's go to our next topic. If I can find it. Here we go. One problem I wanted to review, and again, if you go to, let me bring this up to your Blackboard account. Here it is right here. So here's your Blackboard account, and if you go to Week 9 Managerial Accounting folder, you'll see a list of review work with the solutions there, 18.3a, 19.1, and 21.3a. We're going to look at those a little bit during the course of the night. We're also going to, I didn't do too much of an introduction video this week because I got a little bit behind, but I did send our agenda out, and I'm going to, this is a little 3.5-minute video explaining the break-even analysis. So we're going to take a look at that after our break as a lead into Chapter 21. And then here's an outline of that break-even point and some of the calculations and the PowerPoint that we'll be looking at for that chapter. So this is our makeup for this week. If you go to Week 10, Course Concludes, you'll see some samples of some sample problems that you might be able to run into on the examination. The solutions are there. Should you study these? Don't worry about Chapter 22, sorry. That's a typo. That should not be there. But if you need any, if you want any review of chapters 11, 13, 18, or 19, these might be some templates for you. But basically the problems, we've talked about the problems already: reconciliation, receivable, accounts receivable, depreciation, current liabilities. And tonight, the problems that we reviewed from 18, 19, and 21 are what you need to be concerned about for the examination. But these are some of the review problems from past chapters that you might want to look at. Okay, so back to week number 9 folder. Again, this is the work we're reviewing tonight in regards to this. One of the things that's a little bit weird about this course, amongst other things, is that this is our last teaching class, lecture class. Next week, we have a class where all our materials are posted. And the reason for that was I didn't want to mess with too much going into that final week of May, because I wanted to give you a significant amount of break prior to the summer term. And also this online stuff, I know is wearing thin with some students, and I don't blame you. It's tough. It's a different format. And so I wanted to wrap up the course next week. I didn't want you to be doing an examination into the first week, June 1st or May 31st. I wanted to give you a 2-week break between spring and summer. So that's why we're wrapping up the lecture part of our class tonight. And next week, we'll talk a little bit about the ending material and where this leads you into other classes. So that's why I decided to go about doing that. So that's what we're going to do tonight. I want to look at a thing here. Let me get this. There we go. A little bit smaller. This is another problem from chapter 18. And remember, chapter 18 is talking about job costing, recording cost of goods, the materials, labor, and overhead. And I wanted to show you a couple of examples of this, of the schedule. Again, remember the financial statements of the company that we've been basically looking at throughout our course have been the income statement, the balance sheet, and the statement or the statement of cash flow, or the and also the equity, cost of equity, or excuse me, the retained earnings or equity statement of a company. Boy, I could get my acting gear here. But now we're taking a look at the latter part of our class with this, and I want to bring this up here. Oops, that's not it. See, this is why I don't like WebEx. Sometimes it does not work always clean. So I just want to make sure. Hang on, guys. I'm sorry. I'm having a little bit of computer problems here. Just a sec. There we go. Hope you see this. It's cost classifications, chapter 18 and chapter 19. This is what we've been talking about the last couple of weeks, which has been a little bit different than the financial accounting aspects that we've been talking about. It's cost classifications. In the prior weeks, we talked about cost of goods sold in relationship to inventory and selling product and what it cost us. We've been talking about operating expenses of a company. But now in the latter part of our class, the last couple of weeks, we've been talking about managerial accounting. and ways of determining what it costs us to produce a product. It's called manufacturing costs. And the two main costs or types of costs are variable and fixed costs we've been talking about. We're going to be seeing these variable and fixed costs in chapter 21 to determine the break-even point. But a variable cost per unit stays the same, but in total dollars, it always changes with volume. In other words, if I have a cost of a variable cost of $10 and I produce 10 units, my total cost is $100. But if my variable cost is $10 and I produce 20 units, then my total cost is $200. That's the perfect definition of a variable cost. Per unit, it stays at $10. But if volume increases or decreases, the total dollars expended are going to change. That's the nature of a variable cost. The fixed cost is the direct opposite. The total cost always stays the same. But if we produce more and as volume changes, the per unit goes up or down. Fixed costs as a total are always the same. Variable costs as a total change with volume. So we need to know that designation as a cost. Also, we got another definition within that chapter of product and period costs. A product cost is what it costs us to manufacture the good. Okay? And sometimes we call that the cost of goods sold. It becomes a cost of goods sold when we sell it. All right. The product cost is what it takes us to produce the product and provide the service. Period costs are costs associated with non-manufacturing, not associated with producing the product, but associated with the other cost of a company. Advertising, marketing, HR, accounting, purchasing, selling, general and administrative expenses. Those are the other costs of running a company. All right. Tesla produces an automobile. Yes, they have a cost of goods sold, the cost of producing the automobile. But also Tesla has other costs, HR costs, accounting costs, costs that are not associated with the production of their vehicle. And those are called period or other operating expenses. So we have variable and fixed, which is the type of nature of the per unit or cost of a product. We have product or period cost designating what our costs associated with our producing product and other operating costs of the business. And then in chapter 19, we broke down these manufacturing costs into materials, labor, and overhead costs. Materials and labor usually are considered variable costs. The same on a per unit basis, they change with the amount of units you paid. Labor will go up if you produce more product. Materials will go up if you produce more product because you need more materials. Variable costs are also materials and labor. And then there's overhead. Overhead could be a cost that's fixed. Overhead is to support production costs like assembly foreman, rent on the building. Depreciation is considered an overhead cost. So these costs are associated with the production of the products. And in chapter 19, we assign them to various jobs, assign them to a cost center. A lot of you work in companies where you work in a department of the company. That department could be a revenue generator, but it also could be a support department like HR, like accounting. And the cost of running that department, the company keeps track of. If it was a production department, you were actually producing the product, you would have materials, labor, and overhead costs. But if you're a support or non-manufacturing department, you're going to have period costs, salaries. You're going to have HR, accounting. They're not going to be broken down by materials, labor, and overhead. They're going to be broken down by the department that is providing this non-manufacturing support. Now, if it was manufacturing, like materials, labor, and overhead, they go into the process of keeping track based on 3 different types of cost centers. Work in process inventory, when you move materials, labor, and overhead into production and produce the product. Once you produce the product and it's completed, then it goes into the finished goods inventory, ready to be sold. Excuse me. Finished goods could be in a warehouse. Finished goods could be in a parking lot. Finished goods could be in a silo. Finished goods could be under a tent. It's waiting to be sold to your customers. And then once you sell them to your customers, they go into what is called a cost of goods sold. It's an expense. You no longer own it. The business no longer owns that inventory. Somebody has given you a selling price and purchased it from you. The cost of producing that product now becomes an expense, taken out of finished goods inventory to cost of goods sold expense. And that's the process we've been studying in our class the last couple of weeks, is understanding those different types of costs associated with manufacturing a product. All right. There's basically three types of businesses in the world, and I'm being very general about this, but it's about right. One business is a service industry. You produce a service. University and education could be a service industry. Consulting companies, public accounting firms, even travel agencies would be considered service agencies. Then you have the retail business, selling of products. Now, this could be anywhere from restaurants to manufacturing goods to TVs to computers. That's called retail. You produce a product and you sell it. Now, either you produce it or you buy it from another vendor, but somebody's producing it. That's retail. And then the last or third one is totally manufacturing, where all you do is sell to vendors, sell to people who want to take your car and sell it to somebody else, or take your product and sell it to somebody else. The manufacturing side. So in this class, we've talked about those three different types of businesses now. In the beginning of the class, we talked mainly about service companies, providing a service, consulting, travel, whatever. Then in the middle part of the course, we talked about the retail industry, selling products at retail. And now in the latter half of our class, we're talking about actually producing a product to sell to somebody else, manufacturing. And those are the three main types of businesses in the world. Now, it just so happens, and this is what you're going to be studying in other classes down the road, is that in America right now, we're becoming more of a service-oriented economy. We provide services. The manufacturing is done offshore, China, India, South America, Mexico, Canada. We have basically changed our economy over the last 30 years to more of a service industry, and now and then the retail industry is still going on, but that industry, as you all know, is changing. Talk about JCPenney and a few other companies this past week have declared bankruptcy. The nature of retail is changing in America. And the manufacturing of products, we still produce a lot of products in America, but not like we did in the 1960s and 70s. And that has changed our economy. If you notice in the economy right now, there's an unemployment rate of roughly around 14, 15%, probably be 25% at the end of May going into June. But who are the people out of work? People in low-paying jobs, service jobs, or retail jobs. A lot of the higher earning people are still working. Why are they working? Because they have technology. They can continue to do their jobs through technology. Now, this is not saying that these people are better than anybody else. That's far from what I'm trying to say. What I'm trying to say is that our economy has changed, and there's basically two types of employees, two types of labor. The labor in the service industry and the retail industry that is based on volume and supply and demand. And the labor used in high tech or high profile industries that you can do your work still on a computer at home. You don't have to be in a manufacturing shop or a retail store. That's why you guys are going to college, to put yourself in that category of higher paying jobs that you will not be as affected as much by an economic slowdown. Now, yes, there are. I know a lot of professors out of work right now. I know a lot of lawyers out of work. But the majority of that type of labor is still working, where the bulk of the unemployment is on people who perform in the retail industry, the travel industry, food, restaurants. somewhat lower paying jobs. And they're being affected greatly by this. And hopefully that will come back, and I'm sure it will later on in the year. But these are designations within a company, how you allocate and how you know. Why did people get laid off and why didn't some people get laid off? It's because of the cost. It's because of the reward. The people who got laid off means that those products aren't selling. So there's no revenue coming in to offset the cost. Whereas here at the University of Laverne, yes, the mode of the platform of education has changed. Professor Hassey is still working. Why? It's gone from a on ground or in class to online. Now, depending on whether you like that or not, that's understandable. But the nature of the course has just changed platform, but we're still teaching the course and still generating revenue, still generating the service of education. That's where you want to understand within your own company and within your own industry, where are the costs, how are the costs affected by revenue stream, and if that revenue stream changes, how those costs are affected. Do you get laid off or not? This is important understanding as you move farther on in your academic career and take that Business 330 course. In the Business 330 course, we decide, oh, let's create a new product. What do we need to create a new product? We need capital. Also, we need a product that's going to sell. What happens if the product doesn't sell? Can we change that selling to a different part of the world? Can we sell it to a different market? All these questions evolve around the moving or the strategy behind making business decisions. And the information we're learning in this class is helping us understand the numbers or the information we need to make those business decisions. What is it costing us to produce? What is our break-even point? How much of our cost is fixed or variable? That's a big question in businesses. Fixed costs that you cannot change. They're going to be there no matter what. So that's the importance of understanding and knowing this material. So let's bring this up here. Excuse me. So as I had this problem up earlier to lead me into our lecture and discussion, this is an example of those costs in a setting, in a statement that tells us something. What does it cost us to manufacture our product? All right. Now, I'm not going to ask you to do a cost of goods manufacturing statement, so don't anybody jump out the windows over this. But this tells me and this shows me what those three costs are. Remember I said the cost of producing something are materials, labor, and overhead. This is a perfect example of showing how that works. Materials, we have some in inventory. We purchase some additional materials. We have this available to use. We take an inventory at the end of the period. The difference between what we have available and what we have left must have been what we used. That becomes a cost. Direct materials used. Beginning inventory, purchases, ending inventory, that's what it cost us. Many of you, and I still do, I still do. If you have an adjunct instructor in your class, we have to every 2 weeks fill out a time card. Fill out it seems kind of strange, and I'm constantly shaking my head about that, but it's the way of the world. We have to fill out a time card. Now, we don't punch a time clock, but we do fill out a timesheet. What class, how many hours we spent on that class, blah, blah, blah. Well, that's how labor is figured. How many hours have been expended to produce the product? And in many companies, you have a time card, a time machine. You keep track of that labor. And it's times the rate of that labor pay that you get paid, and there's your direct labor cost. And then we get into the wonderful world of factory overhead. Notice all the different costs associated here. But notice all these costs have to do with the factory. That's why it's considered a manufacturing cost. You don't see any HR cost here, any accounting or selling costs. These are all indirect cost of producing our product. Depreciation, supervision, supplies, utilities, indirect labor. What is indirect labor? It's like your maintenance staff in the plant who keeps the plant clean after hours. That's indirect labor. Without them, the plant will be a mess and we couldn't produce anything. So if you're involved in maintenance in a plant after hours, you're called overhead, indirect labor. Miscellaneous production costs, rent expense on the factory, maintenance expense on the factory. Maintenance supplies it could be. So these are all considered overhead costs, cost of indirectly for production. We have material, labor, and overhead. We spent, in this example, $1.9 million on manufacturing. At the beginning of the period, we had this in work in process. At the beginning of our fiscal year, we had this in production, not yet completed. We add in the additional costs during the course of the year for materials, labor, and overhead. And we have total work in process. We take an inventory at the end of the year. There's $19,380 of cost still being produced. They haven't been completed. So that means this has been manufactured. This amount goes on into finished goods. We produced and manufactured 1,935,000 goods. That's our cost of goods manufactured. So this statement of cost of goods manufactured probably would be for the manufacturing people who are accountants or managerial accountants of manufacturing. What did it cost us to produce this year? Oh, it cost us $1,935,000. Materials, labor, overhead. Since we're not accountants in here, we don't have to worry about the journal entry flow through the system, which is good. We just have to understand if somebody says, hey, what is cost of goods manufactured? Oh, Mr. Hassey, that's easy. It's materials, labor, and overhead in conjunction with the inventories in materials and the inventories in work in process. Take all that into account, we can determine our cost of goods manufactured. Every month of every year, anybody who produces anything does this statement. Apple Computer, Tesla, General Electric, whomever. What does it cost us to manufacture our product? Because let's say they produced X amount of units. Then we can determine what our cost per unit was. Okay, let's say we produced, let's say we produced, to keep this simple, let's say we produced 1,935,650 units during this time period. That means it cost us $1 per unit. And let's say we sell our product for $5. Oh, that's pretty good. So we're selling it for $5 and it's costing us to make it $1. The difference of the $4 has to now cover the period costs, the non-manufacturing costs, plus make us a nice little profit. That's how companies determine selling prices. How much they mark up the selling price above their cost. So they determine a cost of goods manufactured and then how many units you produce. There's our cost per unit. What did we sell it for? Oh, okay, cool. We now know what we're selling it and what it's costing us. You're in big trouble is when it's costing you $1 to produce a product and you're selling it for 75 cents. Whoops. Then you know you're in big trouble. That's why companies need managerial cost accountants to keep track of this to make sure they got a handle of their costs. One of the biggest reasons, there's two big reasons why companies fail. Excuse me, three big reasons why companies fail. small, medium-sized, large corporations. 3 reasons why companies fail. One, and the number one reason, ego. Management's ego. They think they know everything. They know squat. Number one. Number two, we don't understand the market that we sell our products in. You don't understand the market. Who are our customers and why do they come to us? And number three, we don't have a handle of our costs. We don't know our costs. We don't know what it actually costs us to produce a good. What is our material cost? What is our labor cost? What is our overhead cost? It seems kind of simple here. Geez, that's pretty easy to figure out, or based on what this is. Many companies have a very difficult time doing this because costs can be all intermingled and they can't keep track of them. They don't have the systems, they don't have the accountants, they don't have the wherewithal to manage this. Big reasons why companies fail. Ego, market understanding, understanding their costs. Huge. And you're going to have to deal with this most of your life. If you're running a business and understanding how to make a profit, you want to make a profit by selling your product in the market for as much as the market's willing to pay, and it's costing you minimal to produce it. You do that, you'll become Apple Computer. You'll be all set. And notice, here's the cost of goods manufactured, and notice how this applies to the income statement. Here's our income statement. Here's what we sold. Here's the finished goods inventory last year, what we started out the year of goods ready to sell. And here's what we produced this year and completed. There it is right there. We take out the ending inventory in finished goods, what we haven't sold, the difference, voila, cost of goods sold. Cost of goods sold. We had this available at the beginning of the year. We produced this amount. How did we know how much that was? Right here. Materials, labor, and overhead. And then we have an ending inventory that we haven't sold. The difference must be expense, what we sold. And the difference between sales and our product cost is called our gross profit, our markup. And then we have our period cost, selling and G&A. The non-manufacturing costs, which a lot of us are part of these costs. A lot of us aren't on the assembly line. A lot of us are not supervising manufacturing. A lot of us are working in sales, advertising, accounting, HR. We're period costs. And notice those total of those period costs are operating expenses subtracted from the gross profit. There's our income before taxes. We pay Uncle Sam and Gavin Newsom, and voila, we're making a nice little profit. Why are we making a profit? We know the market we're selling in. We have an idea of what it cost us to produce and provide for backup or intercompany services. We manage all that correctly and we pay Uncle Sam and Uncle Louie. There's our profits. That seems so easy, but so many companies have a very difficult time getting a handle on that. And that's why you're studying it here. Because if you go on into a marketing class, one of the first thing a marketer wants to know is how much are we marking our price up over cost? And will our customers buy that product? Right? Why is Apple Computer one of the richest companies in the world? Because they can get away selling phones for $1,500. A lot of us can't afford $1,500, but we still buy an Apple phone. Why? It's the brand. It's the history of the product. It's the marketing. Where if we wanted a regular cell phone, we could go to Samsung or to somebody else and pay $400, $500. But we want to own an Apple. And that's why Apple is so rich. People are willing to pay that revenue for that product. Same thing can be said in any industry, from education to phones to cars. Why can they sell a Rolls Royce for $900,000 a year? Because the people are willing to spend 900,000 and can afford to spend 900,000, want the brand. I can't afford a $900,000 car. I can only spend $60,000, $50,000 on a car. Why? That's all I can afford. I would love to have a Rolls Royce, but I can't. So most of the market is me. You don't see too many Rolls Royce commercials during the Super Bowl. Who can afford a $900,000 car? But you see a lot of Ford Motor Company commercials during the Super Bowl. Why? They're after me as a market because I can afford $50,000 car. That's advertising. They know where their market is. And these all play into understanding that whole deal. Kind of important. So make sure you understand this. Understand what it cost us to produce a product, materials, labor, and overhead. Understanding the difference between product cost here and period costs here. Operating expenses. That's important too. And understand the flow of inventory, beginning, available, ending, and how that plays into the overall financial aspects of a company. This sets the basics for what you're going to be taking later on in your program: marketing, organizational management, finance. All the courses down the road for you are all going to be using these as a barometer of how they're doing. Are we doing it correctly? What are we doing wrong? It's this information that the managerial accountants provide to those areas about how they're doing. And that's an important thing to know. So let's take a break. And when we come back from break, we're going to take a little bit of a look at chapter 19. Again, more specific by job, that little detail, and then talk a little bit about chapter 21. So let's take a break, and I'll see you all in, let's say it's 6:50. I'll see you a little bit after 7. How about 7:05? I'll see you back from break. Thanks, everybody. Okay, we are back. Let's make sure I can't see anybody tonight, so I'm kind of talking to the wall here. But let me just make sure everybody is okay. Kathy Campbell, you okay? Tori, you okay?
Can you hear me?
I can now.
Okay. Yes, sir. I'm good.
Okay. Gabriella, you okay?
Yes, Professor, I'm here.
Vince, you all right? Vince, you're okay? Marianne, you're all right?
Yes, I'm here, Professor Hassey.
Thank you very much. Let's go back through it again. Kathy Campbell, you all right? You're there? Oy vey. Vince Wainwright, are you available and can talk? Okay. Page 715 of your textbook, as you can see on the screen, is a problem that has to do with job order costing. Problem 9-1A. And I want to go through this. because it gives us a perfect definition of what we mean by costing, not by total cost that we just saw in chapter 18. It cost us $1.9 million to produce a product. Okay, that's great. But what is it costing us to produce individual products? And those products can be designated by a job number, or more in the real world, and we talked about this last week, given ID numbers. Something that you can, the barcodes. Those are ID numbers, and companies can isolate costs by those ID numbers or barcodes and determine what it costs them to produce the product. Here's an example on page 715 of your textbook. We have 3 jobs, jobs 306, 307, and 308. Jobs 306 and 307 were started in March. Materials, labor, and overhead. Job 308 hasn't been started yet. Then in the problem, they assign more costs to those jobs in April, and job 308 begins. Materials are allocated into the production, labor is assigned, and notice we have to apply the overhead. That's the mystery here. Remember, overhead, as we saw in chapter 18, is made up of numerous amounts of costs. Factory this, factory that, depreciation, indirect, utilities, a bunch of things. So many times companies can't wait to account for all those costs. They apply overhead at a designated rate. I'll say that again. Many times because overhead has so many different costs, it's very difficult to keep track of those on a month-to-month basis. So what companies do is they allocate overhead into production at a predetermined rate, and then at the end of the process, they account for whether they applied the overhead correctly to the actual costs. And in this problem, it is told to us in the example right here. It says right here, predetermined overhead rate is 50% of direct labor cost. That's their overhead rate, 50% of direct labor cost. In other words, what we spend on labor, 50% of that, it will be an additional overhead cost based on how we calculate out our overhead. Many companies use overhead at a predetermined rate as a percent of labor cost. Many companies use square footage. University of Laverne happens to use square footage as an overhead applied amount. But as you can see, look at here in March, job 306 and 307. Labor is $20,000. Look how much applied overhead is. Oh, 50% of that, $10,000. Look how much labor is in job 307. Oh, $18,000. 50% of that is overhead. So we're applying overhead as a cost based on a predetermined rate. So let's complete this chart for April. $135,000 of direct labor, $85,000 of applied overhead of direct labor. How much, Kathy Campbell, will applied overhead be for job 306? Mr. Wainwright, how much would applied overhead be for job 306?
That'll be about 40, I'll have to do a calculator.
Vince, your voice has changed. Is this Vince? Who was that was just speaking?
It's 42,500.
Very good. Is this Kathy?
Yes, it is.
Are we having trouble with our hearing tonight or our communications? Is everything okay?
No, everything's okay. Just sometimes it pops in and out on the phone.
Oh, phone. Okay. Very good, Kathy. 50% of direct labor, 50% of 85,000 is 42,005. Kathy, you're on a roll. what would be applied overhead for job 307?
It would be 75,000.
Very good. And what would be applied overhead for job 308?
52.5.
Very good. Excellent. Kathy now is a managerial accountant. She's a cost accountant. She has now allocated all the costs into each individual job, materials, labor, and overhead. And now overhead is applied at a rate. And the rate here, as Kathy has determined, 50% of the direct labor cost. Well, here's what those numbers look like. Kathy said 42.5, 75, 52,005. Very good. So now we have the cost for April, and we have the total cost of producing. Let's say all the costs are in, the product is completed and assigned in April. So it cost us $321,500 to produce job 306, cost us $507,000 for job 307, and it cost us $257,500 for job 308. The total cost of all of those three jobs, $1,086,000. So here we're not looking at the total cost of goods manufactured. We're breaking it down by specific type of job. Now that job could be a department. That job could be a specific unit of product. That job could be a division. The company designates what those jobs or what that designation is, but you're splitting it. You're getting a handle of what it costs in each one of those different areas to provide that product. Materials, labor, and the new thing that we're talking about here in Chapter 19 is applying the overhead cost at a predetermined rate. And that's what Kathy just did. Now, the rest of this problem is doing journal entries, and you don't have to be worried about that. You don't have to worry about the journal entries for this. Just understand, when I say a company is on a job order cost system, that means you have to represent the cost by job. And what are the three costs? Materials, labor, and overhead. And what can overhead be? It can be applied at a specific rate. Here in this problem, 19.1a, it's assigned at 50% of your labor cost. 50% of our labor cost. And then later on in the accounting year, we'll make sure that these amounts are correct when we take a look at the actual overhead costs. And did we apply it correctly? And many times there has to be adjusting entries for that, but you can worry about that if you're going to be an accounting major. You don't have to worry about that here. The key thing here is that we're designating manufacturing costs not as a whole, but by individual cost center, product, department, whatever. And notice each one of these have different total costs. The revenue stream to fund these products might be a different selling price. So we're isolating those out. And that's why this is important.
Hey, Professor Hussey.
Yes.
It's Marianne. Just out of curiosity, is that rate adjusted at some point? I mean, do they review the costs, and as they go up, that rate would be adjusted at some point, or?
That's why we have public accountants, Marianne. At the end of a fiscal year, at the end of your calendar year or your accounting year, when the auditors, the public accountants come in and review your books, usually part of the service that the public accounting firm has is to take a look at how your overhead is being applied, and has it changed or can be corrected in the next business year. Usually that's a job for public accounts. If a company is huge, like a big manufacturing company, which a lot of companies are, they'll have internal cost accounts, and this is exciting. Their whole job, 24/7, is to monitor and track overhead. But that is also verified at the end of the year by the public accounts. So that's how that works.
Okay, thank you.
Isn't that exciting?
Yes, it is.
Oh boy. One of my first accounting type jobs when I was very young was to just out of college was my sole task was to making sure all the costs were properly accounted for, materials, labor, and overhead. And this was in a service industry. The service industry was a consulting firm, but they wanted to isolate what does it cost us for a particular job, a particular client, what does it cost us? So we allocated what were the materials. Usually that was office space. Labor, the actual labor that's spent, then the overhead, the additional overhead of servicing that client. And that was one of my first jobs in the world was to do that. Fortunately, I only had to spend about 6 months on that and I moved on. But this is done a lot. Now it's done a lot by computer. Computers track all this, but you need accountants, cost accountants, and public accountants to monitor this. And that was a great question that Marianne gave us, is because usually annually this is reassessed and making sure those overhead rates are correct. Very good. Okay, so that's job order costing. That's what you need to know about this. It's common sense. It's just you got to understand what materials, labor, and overhead is. And then once you know what overhead is, how is it being allocated into the cost cycle? Okay, let's move on. And let's bring up this. Hang on, I'm bringing up a white. Nah, let's not do this. I hate WebEx and whiteboards. Don't agree with me. So I'm getting out of this. Let's do this. Okay, here we go. Big question that we now have for our last topic of our class is, when do we make money? When do we make money? When is the amount of sales volume covering all our cost? And this is the question of chapter 21. For example, I'm not supposed to tell you guys this, but the hell with them. Do you realize at the University of Laverne, if we have 8 students in a class, that equals a profit? And if you mention this to anybody, I'll tell them I've never said that. But that's a fact of University of Laverne. If we have 8 students in a class, we make a profit. The university makes a profit. In other words, the tuition revenue that they charge for that class minus the instructor's cost, the cost of providing overhead, which is advisement, all that stuff, the cost of the computer system or whatever. At 8 students, they're making a profit. Not very much of a profit, but they're making a profit. Why is that important? Well, many of you might have run into this at the University of Laverne. I'm sorry, your class is canceled this term. Why? You only have 4 students. We cannot teach the class. It's not making any profit. What do you mean? I thought Laverne was not for profit. What do you care about a profit? You just have to provide me an education. I only wish a student would tell an administrator that. But if any of you ever taken a class at a community college or a state college, Cal State, or the Cal University system, many times you walk into class on the first day and on the bulletin board or on the chalkboard it says class has been canceled before it even started. Why? There weren't enough students taking the class to warrant the expenses. Okay? You got to cover expenses. Now, in most cases at the University of Laverne, especially nowadays, they combine classes. The class of business finance next semester is a combination of students from Burbank. Can I tell you this? Yeah, it's fine. It doesn't mean anything. It's a combination of students from Irvine, Burbank, and Ontario. Because it's an online class, they can be anywhere. And because of that, they'll have more students in the class that will substantiate the charge and the cost of running the class. Now you might want to say, hey, Mr. Hassey, it's an online class. What are the charges? What are you talking about? Well, even though it's not in a classroom, and you're right, there will be costs associated with the classrooms are still there. They still got to be paid for. All right. And also the blackboard, the infrastructure has to be paid for. And so that's why there's a large argument going around the country now, not at Laverne, but going around the country is, hey, I'm taking my class online. Shouldn't there be a reduction in tuition? Legitimate question, but on the business side, that ain't going to fly. Why? Because the classrooms are still on campus. Even though they're empty, they're still sitting there. You're paying for the debt service, you're paying for the depreciation, you're paying for the expenses of just having that class there. Now, whose fault is that? It's nobody's fault. It's the law. It's safety. But we still have to cover that, so when this pandemic gets over, those classrooms will still be there. If we don't cover that expense, there's a chance that some of those buildings will go into default and not be there when we come back. So that's the reason why we keep track of these costs, and reason why in many cases there's not a tuition. Now, for students, if you're living on campus, you get your money back if you have room and board, because you're not sleeping in the dorms anymore. You're not sleeping, you're using the food service, you get your money back. But here, technically, even though, yes, you're sitting in Glendora, or you're sitting wherever you are tonight, that class in Burbank is still there. And we got to cover that cost. So that's how that all works. Now, I hope I didn't open up a big can of worms by this, but it's you guys should know this. This is the way it is. So how does a university or how does a company determine when do they make money? Okay, it's called the break-even analysis. What is the break-even analysis? It's a formula. The break-even point in units is equal to total fixed cost divided by the selling price per unit minus the variable cost. Per unit. For example, if my fixed costs were $270,000, my selling price was $100, and my variable costs were $60. See, this is why Chapter 18 is important to understand. What is the fixed cost again? What is the variable cost again? Oh, okay, I got it. Well, if I do the arithmetic, $270,000 fixed cost divided by 40 bucks. All right. Well, let's do the math. Where's my calculator? 270,000 divided by 40 equals 6,750 units. In other words, if we produce and sell 6,750 units, this is called the contribution margin, which is $40, will cover the $270,000 fixed cost. So if we sell 6,751 units, we make 40 bucks. We sell 6,752 units, we make 80 bucks, and so on. But once we hit 6,750 units, we have the fixed costs covered, and we're beginning to make a profit. To understand that is huge for a business. All right? That's how Laverne calculates why they need 8 students in a class. That's their break-even point. They determine the fixed costs. They determine the selling price per unit, which is the tuition we charge per credit hour. And they determine the variable costs of providing that class to the students. They can determine 8 students is our break-even point. I have a friend of mine who works in management at In-N-Out Burger. At every store of In-N-Out Burger, they know how many hamburgers and meals they have to serve every day to cover their costs. If they total up the end of the day and they sold 1,100 hamburgers, that's their break-even point. If their break-even point is 1,100 hamburgers, they sold 1,200, they know they made a profit. Every company has their break-even analysis. How many computers do I need to sell in a month? How many apartments do I need to rent to cover my cost? Whatever. That's why this analysis is very important to know. What would be the break-even point in dollars? It would be fixed cost, $270,000, divided by what is called the contribution margin ratio. What is the contribution margin ratio? All right. The contribution margin in this example here is $40. $40 is what percent of 100? 40%. That's the contribution margin ratio. 40%. So if I take $270,000 fixed cost and divide it by 40%, I get, let's get out the calculator, $270,000 divided by 0.4. I get $675,000. Oops. That's my break-even point in sales. How can I verify that? I can just take my selling price of $100 and multiply it times 6,750 units. That's my check figure. Let's get out the calculator. I take $100, my selling price times 6,750, I get $675,000. That's my break-even point in dollars. And that can be calculated by taking the relationship of selling price minus variable cost. That's 40 bucks. That's called my contribution margin. What percent is that $40 of my selling price? That is 40%. Take the 40% into my fixed costs. I convert break-even point in units to break-even point in dollars. And there you go. It's that easy. It's that easy. And the thing about this is why it's important. It tells you as a manager, when do I start making money? And that's why a lot of people over the last 2 months have been laid off. They know the volume is not there in businesses to get to their break-even point. They know they're going to lose money because there's no revenue, there's no sales, there's no units being sold. So they know they got to cut that, they got to get rid of those costs associated with that product. Bingo, layoffs. And that's how managers manage. They know if that revenue stream they're not selling and they're not going to get to that break-even point, then they know they have to make management decisions. And who provides this information? The managerial accountants. Because they know what the fixed costs are. They know what the variable costs are. And of course, they got to know what the selling price is. So they can calculate this information and give you that data. And that is huge. That's our last step in this class of managerial accounting information. When do we make money? And that's going to be a key question when you move on into other classes, and we'll talk about this more next week. Should I make an investment in an asset that produces a profit? But if I know my revenue is too high, if my break-even point is too high, will I ever make a profit at this type of asset? Maybe I better figure out something else. Can my marketing team sell that many units? If the answer is no in a competitive market, then why go ahead and make the investment? Try something different. Now, a lot of that has to do with branding, reputation, consumer service, all things that sometimes companies forget about. But you, as the managerial accountant, can come up with the hard data to determine at what point do we start making money. Okay, let's take a look at a problem here. Let's go here. I'm bringing up a problem from our textbook. Here we go. I'm on page 806 of your textbook, problem 21-3A. We're going to determine the break-even point in sales units and dollars for this problem, the break-even point. And what I would like you guys to try to do right now on your own, and I give you, here you know you're on the right track, here's the answer given to you in the problem, but I want you to take the information in this problem, the selling price of $200, fixed cost of $270, and a variable cost of $140. And see, using what we just talked about, if you can determine, and I give you the answer for the first one, what is the break-even point in units, and what is the break-even point in dollars? So let's take a couple of moments to see if you can calculate this out based on our information that we did a little bit earlier, and I'll bring that up here. So you have that as a way of looking at it.
I'm sorry, Professor, what page was that on again?
806.
Thank you.
So try to do that problem, and here's what how we did it. But how to do that problem on page 806. Vince, if you're listening, I'm going to call on you first to tell me how you calculated the break-even point in units. So if you're listening, Vince, please note that. And on page 806, they tell us that our selling price is $200, our fixed costs are $270,000, and our variable costs are $140. What is the break-even point in units and dollars for this particular problem on page 806? Take a few moments to look at that, please. Thank you. Vince, are you there? I think Vince blew us off tonight. That's not very cool. Okay. Let's take a look at this. So, Vince, are you on? He's off. He blew us off. Not cool. Okay, I know why he's off too. Can't tell you guys that, but I know why he's off. Okay. Let's see. Tori, tell me how you computed the break-even point in sales units.
Uh, so I'm still working on it. I hate to disappoint you. Because I'm at the trying to figure out the margin ratio.
Well, no, that's for dollars. How much for units?
Oh, units. Oh, okay. Sorry. That I did. You take the 270,000 and divide that by 60 because 200 minus 140 is 60. And that's how you get the 4,500 in units.
Very good. Okay. So our break-even point for this particular company is 4,500 units. And what is the dollar value of break-even? Barbara, can you give me that information?
I don't think Barbara is here today, Professor.
Gabriella, excuse me.
Oh, okay. So to find the break-even point in sales dollars, you will have to get the units that we found in break-even point. So the 4,500 units, and you would have to multiply it by the selling price of 200, and you will get 900,000.
I was looking for more in the line of the contribution margin ratio calculation.
Oh,
Contribution margin.
so
Remember I calculated it here before a little bit earlier, where you
okay.
take the contribution margin ratio and divide it by a percentage into the fixed cost.
Yes.
What would that be in this problem? What would be the contribution margin ratio in this problem?
I didn't do that one.
Well, let's try to figure it out, okay? We know a selling price is $200, and we know our variable costs are $140. What's the difference between 200 and 140?
60.
Very good. And what percent is $60 of $200?
Let me do the math for you.
Excuse me. Variable, yeah, what percent is $60 as of $200?
3%.
There you go, 30%. So that's our contribution margin ratio. So if I take $270,000 fixed costs and divided it by 30%, what do I get? 270 divided by 0.3 is?
Still get 900,000.
Very good.
Yeah.
Very good. Excellent.
Okay.
So that's what I want you to concentrate on. The way you did it is like the check, the backup. But I wanted you to come up with the value of that in terms of the contribution margin. And here's that example here. This is provided in Blackboard, and here it is right here. So again, Tori told us that the break-even point in units is 4,500 units. Fixed cost divided by the contribution margin per unit, which is 200 minus 140. And Gabriella gave us the information of the relationship of the $60 contribution margin to the selling price is 30%. That's called the contribution margin ratio. We divide $270,000, our fixed cost, by 30%, and we get our break-even point in dollars by using the contribution margin. Okay. Now, and also, and there's nothing wrong with this. Gabriella also said, all right, Mr. Hassey, if I take 404,500 units times 200, $200, I get 900,000. That's exactly right. Nothing wrong with that. But I wanted you to get used to understanding what the contribution margin ratio, because the method to that madness means that you're going to be using that when it gets to business finance. That's why I know. And so that's why it's important for you to know the contribution margin. Okay? Make sense? Now, the last thing I need you to know from all this, if you notice in the problem in part C, they ask you to put together a contribution margin income statement for this company. And this is it here. This shows us what our break-even point is. If we sell 4,500 units, which Tori told us earlier, at $200, we're selling $900,000 of sales. And also Gabriella told us about that 900,000 in her analysis. We know our variable costs are $140 a unit times 4,500. That's $630,000. That's our contribution margin, $270,000. 4,500 units times $60 a unit. We know that our fixed costs are $270,000, and thus our net income is zero. So this is called the contribution margin income statement. And many times some companies would like to look at this because, okay, I want to know what our break-even point looks like. Well, our break-even point looks like we sell 900,000. Variable costs are 630 and our fixed costs are 270. There's our contribution margin. That's our break-even point income statement. And sometimes companies like to know that and what it means. And you guys have just figured that one out. Good job. I know a lot of bankers who can't figure this out. So you guys have done a good job. It's the sales that is needed to break even, the dollars that are needed to break even, and transferring those into variable total cost and fixed costs, we can show, oh yeah, if we sell $900,000, we're going to make absolutely nothing. But if we sell 4,501 unit, we're going to make $60. That's our contribution margin, the difference between variable cost and the selling price, $60, because we've now covered all our fixed costs. So if we sell one more unit above $4,500, our contribution margin becomes our profit margin. Write that down. When we sell one more unit above our break-even point, our contribution margin becomes our profit margin. That is something you can bank on next week in the exam and in business finance. That's a key phrase in management. Okay, good job. Very good. That's what you need to know from chapter 21. Break even in units, break even in dollars, and the break even income statement called the contribution margin statement. This is in your Blackboard. Note this. This will be a good study guide because you'll have something along these lines in your exam. Speaking of the exam, there's Gabriella. Hi, Gabriella. Speaking of the exam, let's bring this up. If I go to our Blackboard now, And here I am in our Blackboard site. And if you go to quizzes and examinations, you'll see your final examination in a PDF or a Word doc format. If you download that, you now can begin your work that's due next Sunday at midnight. You can do it in any format you see fit. If you want to do it on PDF, I know some of you like to do that. If some of you like to use Word and just write the answers on the Word doc, or I know some of you like to use spreadsheets. But there's a lot of multiple choice and true and false on this examination. I don't know if the spreadsheet would do you justice, but you're more than willing to do that format. All right. And so if you download one of those files, you can begin your work. And let me get that up here. And here's your final examination. So it's broken down. There's 10 problems. Each problem is worth 10 points. And it just covers basically the last half of our class. Accounting for retail, inventories, bank reconciliation, receivables, plan assets, depreciation, liabilities, corporations, managerial accounting, Chapter 18, cost accounting, Chapter 19, and break-even analysis. 10 questions, 10 points each. Make sure you read each question carefully. And you take your time. You got a lot of days to do this. I know you got other things going on, but you don't have to do this all on one sitting next Sunday morning. Try to do a couple of problems a day. Don't sit down in one sitting. It's because it's going to take you too long and you're going to get frustrated. Try to balance that out. And this is due next Sunday. But also remember, at the same time, you're finishing up your 10K paper. That is due also. So what I would do, no, I shouldn't tell you. What I would do is, and hopefully you're pretty well done with your 10K paper, get that out of the way first. Maybe do that this coming weekend or this coming late week. And then over the weekend, work on your examination, or vice versa. Work on the examination now while it's fresh in your mind, and then finish up your paper over the weekend. However you want to do it. But you got to balance and understand what it's going to take. It's going to take you about 2 to 3 hours to do this examination. 2 to 3 hours. It's going to take you however long you have left on your paper, so you just have to balance your time out and figure that out, okay? Also, know where you stand in class. If you got a solid A average, it gives you a little bit of breathing room. But if you want to get an A and you're in A minus or B plus territory, and you're going to have to put the pedal to the metal, then you got to concentrate and focus on getting a better grade on this examination to get that A in this class. So just as I said earlier tonight, make sure you understand where you stand in class currently. And then you have these two pieces of information totaling roughly about 40% of your grade. Almost half your grade is in these two problems, these two assignments. So take your time, spend time on it, and answer the questions, and you'll be in good shape. Now, I will not take drafts or examples, but if you have questions on the examination and understanding the questions, feel free to text me, send me an email, come to office hours on Thursday night, and I'll answer those questions. But I won't look at any samples or drafts or anything like that. But I will answer the questions if you need some clarification at any time. But also remember, we have office hours on Thursday night. so that this will complete your course. This will complete this course. And if you go to the last page of this examination, hello, here it comes. I'm getting dizzy. Here it is. You'll see a professor note. And in it, I'll tell you that this has been a pleasure to have you in class, blah, blah, blah. There's my email address. If you ever need any help or care or information in the future, if you need a letter of recommendation, we'll talk more about that next week. This Blackboard site will be open through 2022. If you post your course evaluations by Wednesday, May 27th, you'll have your grade posted by Thursday, May 28th. And here's the link and the explanation of how to do your course evaluations if you've never done these before. There's some information on how to do that. So that is in the last page of your examination that you will download. Any questions, people?
Hey, Professor Hassey, it's Marianne. I looked in there for that evaluation. I don't show any course evaluations available to complete right now.
All right, let's go in and see it. Let's do that. I find that hard to believe, Marianne, but let's verify that. Let's bring this up so I can share this calculation and how we do this.
Yeah, Professor, I just went in. It says no course evaluation surveys are available at this time.
All right,
That's
well,
what I see too.
yeah, okay, well, let's double check that. All right, I'm bringing it up. Now I've seen that everybody has filled out their evaluation except for Kathleen and Vince. Oh, this is for the April one. This is not for the end of the one. Ah, I see.
Yeah.
Yeah. Okay. Thank you, Marianne. I'll tell you what I'll do. I'll find out about this by contacting Susan Lamelli. They should have recycled this before and put up the new amount. So let me, I'll find out about that, guys, and let you know, okay? So don't worry about that. And if this is not going to be available to you guys, if there's some glitch or they're not doing this, I'll just post all the grades no matter what, okay? So don't worry about that. So I'll find out about this and let you know. Thank you, Marianne, for checking that for me. I appreciate that.
Sure, thank you for doing that.
Okay. All right, let's get back to where we were. All right, there we go. Okay. So, so that's where we stand tonight. Okay. Now I've kind of done my job, or not really, but I've done what a lecturing job is for this class. You are, and we'll talk again. We'll talk about this next week. You are now prepared to go into the business finance class, go into marketing classes, take your education for a step further. Marianne, as a graduate student, you're now prepared to go into the 500D class if you've not already had that. Have you had 500D yet, Marianne?
I've already done that with you, Professor Hassey.
That's right. You were, yeah, you did take that with me. All right. Okay. Yeah. So now you're prepared to go into the 635 class. Marianne, have you taken that class?
I'm enrolled with that with you for the next term.
Oh, you're going to have it for me next term.
Yes, this coming term, I'm enrolled in it.
Oh, I haven't seen that roster yet. Well, Marianne, that's fun. We can do this again.
I'm looking forward to it.
You'll love the 635 class. That's a lot of fun. All right, good. Okay, but that's good. I'm good, Marianne. So you'll hear from me next week by the 22nd with the new syllabus and all that jazz. Okay, I haven't seen the roster yet. I didn't know you were in the 635. Cool. That's a good group. I'll know almost every student in that class, so that'll make it a little bit more enjoyable. For you, probably not for me. Haha. Okay. So again, this is getting you prepared to go further on into your studies. You're going to be using this information in finance. You're going to be using this information in marketing, and we'll talk a little bit more about that next week. So one last time, does anybody have any confusion about when things are due, what has to be due, anything like that? Anybody have any issues with that, please? Okay. And I'll find out what's going on with the evaluations, if even in fact you're going to be asked to do those, no problem. And then matter of fact, I can find that out very quickly because one of my golf partners is involved in doing these evaluations. So he'll tell me. So I'll find out about that and let you all know. So I will see all you guys next Monday. Now, again, we have office hours Thursday night. Is as you're going through this information about your paper or the examination, you have some questions or concerns, or if you have any questions or concerns about your current grade status, let me know. I'll be on Thursday or any other time if you have any questions or concerns. Well, that's what I have. I've recorded this class for a couple of people who were not going to be here tonight, or one person, and for Barbara, she had to go up north. So I'm recording it, so I'll post the recording tomorrow so you have access to that via YouTube and your Blackboard site. So again, everybody, thanks for your work. We have one more class to go, and I appreciate all the effort you're going to be putting in this week because I know you're going to be under the gun. And if you need any help, let me know. Be well, and I'll see you guys all next Monday. All right? Thanks.
Thank you, sir.
Thanks.
Good night.
Thanks,
Thank you.
Gabriella. Thank you, guys.
Thank you, Professor.
Thank you, Kathy, Marianne, Tori. Thank you.